Most important factor at the moment is the Fed believes we're close to full employment, which we haven't been since 2006. And that is what drives its anticipation that it will have to raise rates. The opposing view, because the Fed has announced that they expect to raise rates by 1% over the next 12 months. Now, they're not committed to that. This is what they think they will do. Interestingly, the market says, tells the Fed, you may think you're going to raise rates by 1%, but actually the chances are you won't raise rates at all, and you may only raise rates one time in the next 12 months. Why does the market believe this? It believes two things. One, that the economy is not at full employment, that the 4.5% unemployment rate underestimates the amount of slack in the economy. Mm-hmm. So that's one debate. The second is that even if we are close to full employment, that is not leading to inflation. And because inflation remains considerably below the Fed's target, the Fed does not need to tighten. So I'd be very interested in Alan's view on those two things. Are we close to full employment? And if we stay here, will we get inflation?
Yes, we are close to full employment. Two, if we have very considerable patience, meaning who knows whether it's many months or many years, the answer is yes, it has always happened. It will, but when is another question.
How negative do negative rates have to be to make a difference, if at all?
At some point, it is going to pay somebody to just basically load up on the currency, stick it into vaults, and leave it alone and get a nice return. And it's a sovereign credit, so you don't have any problem with risk. But I think the negative interest rates is not an effective monetary policy.
Looking purely at oil, you've studied also a lot the whole storage question and the capacity for storage worldwide. Where do you see oil going, and how important is that to the economy?
Well, if you look at the official forecasts, which are not too bad historically, they're still forecasting, all of them, 1 to 2 million barrels a day excess of supply over demand.
For the next year, or?
Well, they don't say. I mean, the forecasts I see are for the year out. For the year 2016, most of the official agencies, whether it's the U.S. agencies, the private organizations, the various international organizations, they all have that same structure because they're all using the same database, basically. And if you have 1 or 2 million barrels a day flowing into the market, that will be price depressing until it disappears. If you look at the United States, it's a huge impact. The price of gasoline has gone down dramatically to such an extent that disposable personal income in the United States is really impacted. Now, we're not playing with the excise tax on gasoline, and so that, no matter how you look at it, just looking at the econometrics of it, I mean, gasoline price decline has had a significant impact on consumer spending overall.
I mean, the only worrying thing is you could argue that we haven't seen a pickup in growth. Therefore, the underlying growth rate is even weaker.
Right.
And that's what worries me.
As we look into the next sort of 12, 18 months to the next 5 years, a lot of economists are pretty gloomy I was just at the World Economic Forum, and the mood on everything was very gloomy. But I think, Alan, one of the things you've both talked about a lot and written about is sort of the behavioral part of things.
Because look, what the data do show unequivocally is that fear is a far more potent economic force than euphoria. And you can see it in the economic data. You can see, for example, the business cycle. The unemployment rate goes up very much more rapidly than it comes down. You can see it in every sort of market, that prices tend to fall more rapidly than they rise. I should say claims, income-producing assets. The implication of that is that markets will never respond. Human beings cannot change. Risk aversion is a built-in characteristic, which of necessity means that you will get in indexed equity funds a higher rate of return permanently than you would of a managed equity fund.
Alan, would you fit into the more gloomy, negative economists in terms of looking at the next year or two, or are you?
I think the key statistic is output per hour, and the political, in the United States, the politics, which are awful and getting worse, don't suggest a simple way out of this. So I don't think that the economy is about to crash, because we don't have bubbles that of the type that are caused by euphoria. We've got there's very little euphoria out there. But it also means that nobody is investing.